Howdy, Jacob here. Today we're looking at Hawaiian Electric Industries, ticker symbol HE. So $1.6 billion market cap. Initial P looks pretty cheap, 14.9% dividend yield. So absolutely humongous yield. Enterprise value of 4.5. Looks like that's three times their current market cap. Point seven price to book, um, but they have a lot of debt on hand. So 1.6 billion in 2012, 3 billion, 3.1 billion in 2022. So not quite double the long-term debt, but nearly double. Free cash flow almost 300 for the rolling 12, and then 100 million in 2022, 60 million here, 45 million, 50 million. Okay, so I don't think they can afford a $157 million payout. So to me, if we're looking at a 5-year average, I mean, some of those years are zero. So I might have cut it by 2/3, um, and have the payout be 50 million. I think they can afford that, and even still, that's almost a 5% dividend yield. So it still hits our screener requirements, um, but this company does have a lot of debt. So it's just going to be getting comfortable with that. Because if we have, 100 million, that's, was that 30 times 100 million on the free cash flow side. So I think we can start to just get into some assumptions here. I have a inkling that the debt is the debt's really a frustrating thing to see. But yeah, let's start getting some assumptions here. So revenue side, they've grown so much recently, and I didn't see any acquisition. Well, there was one, but this might just be a cyclical inflationary thing where electrical prices jumped so high. Um, I think that's going to be my initial assumption. So 0% from the essence that it's been so high recently, and the near term might fall a bit, but then come back to pretty much where it's at now. Looks like their net income is much higher than their free cash flow. I don't like to see that. I'm going to do a little bit lower on the earnings side because it probably will get hindered by interest expense with the amount of debt that they have. Free cash flow 2.5. I'll be generous here, and then 0% share change. Yeah, it looks like it needs to drop over 50% before we get to that 15% return that we're looking for here with these assumptions. However, it does fall within the parameters of what we're looking for. We're looking for um, a company that makes profit and has a payout over 4% on the dividend side, and I think even if they cut their dividend to a third of what it is, they're still looking at nearly a 5% dividend yield, so it still hits that marker. But from a price perspective, I'm just waiting, and even if it gets there, I'll probably be tinkering some assumptions as the company has a lot more debt than anything that I'd be looking to get into, unless it were so dumbfoundingly cheap and I knew the lenders weren't going to be coming at them with forks and knives. So thank you, and I hope everyone has a good rest of the day.